Hello viewers, today let's talk about performance of stock market, and I will tell you one secret, that actual performance of stocks is not even close to average performance of S&P. Here's the thing, I will show you a good example. Like, what would average people do? Average people will go to Google and search for average performance of stocks and see them as the reference point. So I will do just that. I will just enter average performance of stock market. Like, what is the average? What are these words? We don't need these funny ask questions, but we need something. Average. What's the average return of stock market? About 10% per year. The average stock market return is about 10% per year as measured by S&P 500 index. This is the thing you would see. But this is performance of S&P 500. That's not performance of average stock, because S&P represents whole index of best performing companies. But there are a lot of companies which are not included in this index, and vast majority of companies are not there. Vast majority of companies at NYSE or New York Stock Exchange or any other exchange are performing much differently. Here's the thing. We hear that this is like 10% per year, this is average, and you could see that was 10%, 11.88, 10%, something like 17%, but this is for last years only. You'll see that notion of 10%, right? Here's the thing. Here's a research that shows that top 20 stocks in S&P 500 contribute to most of its return. This is in May 24th, 2023. So here's what they are saying, that top 20 stocks make only 29% of the weight of S&P 500, but contributed to 7.08% of indices total 7.55% return. Now this is recording of 19th of June, so performances are rather similar, and the time of recording this video represents more or less accurately this research material. What it says, that Apple, Microsoft, Amazon, Alphabet, Nvidia, yes, and then there is Google. Alphabet, two shares, class A and class C of Alphabet, which is Google, Tesla and Meta. These are like top giants which has most of return, and then there are other similar companies, and then there are others. You see 20 companies here, and 10 of these 20 companies are like half of this return, then another 10 companies another 3.5% of this return, and then other companies which represent 70% of all stocks represent 0.47 return. You see, a couple of winners are representing all of the gains in S&P 500, not all 500 companies. That's one thing. And here's the second thing. If we compare this to overall index, like Nasdaq Composite, where I have Nasdaq Composite, yes, here I have Nasdaq Composite. Here, excuse me, what the hell just happened? Oh yes, here we are. Here are our performances. I would just delete everything else and see that this is performance of Nasdaq Composite Index, which represents all of the Nasdaq companies, not only best. And let's compare this with S&P 500 index. So Nasdaq is blue, S&P 500 is darker. This is for last 5 years, so it's notable difference, 63% versus 26%. And then there's 10-year difference, where it's more than double, 70% for 181%. And then there is total difference, which year is that? So this is like objective performance, and we see that it clearly represents better performance, because it is more than like 1,500% versus 5,000%. So it's several fold higher for the best stocks versus all of the stocks. But also Nasdaq Composite is weighted similarly as S&P 500, so most of the gains of Nasdaq Composite is attributed to same stocks as we see in S&P. So best stocks in certain time represent most of the gains on Nasdaq. as well as S&P 500. Only S&P 500 is smaller, so the impact is larger there. And if you would exclude those winners, we would see that these performances are rather bad. And here is one research paper which says that. Basically, there are many papers which confirms this thing, but I'm just taking one which was easiest to find. So it's not mine. I'm not representing these guys. I'm just showing you idea that here's the takeaway. Only about 1/5 of the stocks survive and outperform market in 20-year periods. So 1.5 stocks will be there. And the list rate is very high, so stocks that are taking out of the exchange, not into exchange. And only those who are long enough are able to succeed, like survivorship bias there. And the chance of any single stock outperforming market in the future is not meaningfully different from when conditioning on its past performance. So no one knows the future, in other words. So here's the thing, he has good chart, good table here. So he's saying that chances of surviving for each stock in 5 years is 78%, and from 20 years is like 47%. So most of the stocks doesn't make it, and only 20% of the stocks are making good returns. So think about it. If you are thinking that one stock is good, actually the thing is that not only it will be performing badly, but it will be taken out of exchange because the company would cease to exist in the most times. So it is very, very, very hard truth, and this is also here to show that point, that you look at stocks at the beginning of windows, and here's our percentages of surviving and outperforming and bad delists. So we see that these probabilities are not very good. If you see those data, probabilities of single stocks are bad. What that translates for you is that if you invest in the index fund of S&P 500, it kind of cancels out all the bad possibilities because index represents only good companies. And if you look at like wider indices like Nasdaq Composite, it also includes the very best companies, which skews the performances up, because there will always be good stocks and bad stocks. But if you are looking at single stock, the odds are completely different, and most of the time stocks go nowhere, underperform market and get delisted, and only one of the 5 make it. So if you are looking at single stock portfolio, take this into consideration. 10% won't be average return of the single stock. Single stock will do badly. Index of the stocks will do good. Now that doesn't mean that you cannot invest with good returns. Of course you can, but you have to set very explicit and strict rules how you follow that stock and how you see its performance. We just simply cannot put all the money in 1 or 2 stocks because it has been hot for like last 3 months, because that will do you much worse than regular index fund investing. So it is possible to make good money in stocks. It's possible to make high returns, but it's not possible to do that by simply thinking that stocks will make 10% a year, and if you are making 2 hottest stocks you will do better. No, this shows you that the best stocks make worst of the performances, even though those are giant companies. Most of the stocks are worse than general indices. This is Nasdaq overall index. I don't know why he's making bad drawings for me, but anyways, Nasdaq is performing much worse because it includes all bad stocks, and for one stock the destiny is rather bad because it is only 20% of the chance that it will be better than market, so it's performing nowhere as near as good as you think so be aware of that. Know how to invest in funds, in ETFs and single stocks correctly, and if you want to do that, make sure you are following me and seeing my consultations. So stay tuned, wait for my next videos in this regard. Bye.